Good afternoon, students. Now we are going to see the super profit method. The valuation of goodwill and the shares. Calculate the capital employed and the average capital employed. This is the format for calculating the average capital employed. Now we see the meaning, that is the super profit method is a profit of the firm or compared with the normal profit for the firm. Normal earnings of a business can be judged only in the light of the normal rate of earning and capital employed in the business. Hence, this method of valuing goodwill would require the following information. First one, normal rate of return for respective firm, and the second is a fair value of capital employed. The normal rate of earning is that the rate of return which investor is general expect on their investment in the particular type of industry. The normal rate of return depends upon the risk attached to the investment like bank rate, market, need, inflation and the period of the investment. So the meaning of the capital employed, this is a format of average capital employed, that is trading asset, plant and machinery, land and building, furniture and fixtures, stock, cash, that is all the assets, and then less external liability, with that loan, debentures, creditors, outstanding expenses, capital employed. So the average capital employed is opening capital employed plus closing capital employed divided by 2. That is closing capital employed half of the current year profit plus current year dividend. The normal rate of return is the normal business under normal circumstance or from similar course of business. Normal rate of return means rate of profit on capital employed which is normally earned by others in a similar type of business. The normal rate of return is rate of risk plus rate of return, that is dividend per share into 100 market price per share. As the capital employed may be expressed as aggregate of share capital and reserves less the amount of non-trading asset such as investment. The method for the calculation of goodwill is goodwill by purchase of average profit is find out the trading profit, year of purchase, that is the goodwill, number of years purchase into average trading profit. The goodwill by purchase of future maintainable profits, for the steps which we have to follow is number of years purchase, they will given in the question itself. So number of years of purchase into future maintainable profit. The goodwill by capitalization of future maintainable profit, the steps which we have to follow is normal rate of return into 100. So the goodwill is capitalized value of normal rate of return minus capital employed. The goodwill by purchase of super profit method is normal rate of return, that is normal profit is equal to 100 capital employed into normal rate of return. Super profit method is a average future maintainable profit minus normal rate on capital employed. Value of goodwill is super profit into number of years purchased. So the calculation of capital employed or the average capital employed is total sundry asset, that should not include the goodwill, minus non-trading, current liability, provisions, contingent, and then less half of the current year trading profit after the tax. This is the answer of average capital employed. The calculation of normal rate of capital employed is normal rate of return into average capital employed. Calculation of super profit is average annual adjusted profit minus normal profit. Value of goodwill is super profit into number of years purchased. The capitalization of average profit method is calculate annual adjusted maintainable profit, average maintainable profit divided by normal rate of return into 100. The steps to be followed for the calculate the super profit method is, in the annuity method, V is equal to A by 1, 1 minus 1 plus I. V is the value of the goodwill, N is the number of the years, A is the annual super profit, I is the rate of return. The following particulars are the available in the respect of the business carried by the bank limited. Profit earned in the 16 to 17 is 50,000, 17 to 18 is a 48,000, 18 to 19 is a 62,000. Profit for the 17 to 18 is reduced by 5,000 due to the stock destroyed by fire. And profit on 16 to 17 includes non-recurring income is 4,000. Profit in the year 18 to 19 includes 2,000 income from investment. The stock is not insured and it is though that prudent to insure the stock in future. The insurance premium is estimated 500 per annum. Fair remuneration to the proprietor not taken in the calculation of the profit, that is 10,000. Now we will calculate the super profit method. So here the calculation of annual profit, the profit for the year 16-17 is 50,000, 17-18 is 48,000 and the 18-19 is 62,000. So we have to add the stock destroyed. The stock destroyed by the fire in the year is 17-18. So the final non-recurring income for the year 16-17 is 4,000 and income from the investment in the year 18 to 19 and the insurance premium for the 3 years of 500 and the fair remuneration is 10,000. So all these we have to list the data. So adjusted annual profit for the year 16 to 17 is 35,500. In the year 17 to 18 is 42,500. The year 18 to 19 is 49,500. So average adjusted profit is total 42,500. The value of the goodwill is adjusted average profit into number of years purchase. So 42,500 into number of years of purchase is 2. So total 85,000. This is the assessment question. Thank you.